Hello everyone, good evening. Welcome to ASK Lighthouse Quarterly Update webinar. As we all know, Indian markets are currently facing bouts of volatility. Trump's trade wars and earnings growth slowdown have made investors jittery. The large cap Nifty 50 index is down 14% from its peak in September last year. Mid cap and small cap have been hit the hardest. To discuss this and much more, we have Sandip Bansal with us. He handles ASK Lighthouse Portfolio. He has around 2 decades of experience in capital markets and he has seen many such cycles. So our webinar will be divided into two parts. In the first part, he will take us through market outlook, macro conditions, and portfolio updates. In the second, he will answer your questions and queries. So feel free to type your questions in the chat box below. Over to you, Sandeep sir.
Thanks a lot, Prathamesh. Thank you so much, everyone, for logging into the call on a Friday evening. Prathamesh, I'm sharing my screen, and please do let me know once it's visible.
Yes, sir.
Okay. Thank you.
Yeah, your screen is visible. Yeah.
Sure. So in the first part of the presentation, we'll talk about the markets. The markets, as we know, in the last couple of months, and this data in all the subsequent slides as well, is updated up to 28th Feb. We've seen a slight bounce back in the last week or so. But generally speaking, Indian markets have been down by around 6% in this calendar year so far. And it has been amongst the relatively poor performing or the weaker performing markets globally, which has impacted the returns for the last 1 year. However, if we look at a slightly longer term time horizon, Indian markets still continue to do well on a relative context globally. Yes, we are going through a near term or a short term period of volatility, which has impacted returns, as can be seen from this data, which is the fall of the index from 52-week highs. In this also, India has kind of fallen amongst the most versus its peers. But on a longer term time frame, the market returns have been good. In this last couple of months, if we see, the most impacted segments of the markets have been the mid caps and the small caps. So while the markets as a whole might have corrected, by around, let's say, 15% from their September highs, let's say around 7-8% in the last couple of months for the large cap. But if we look at the mid caps and small caps, they would have been down around 20% for the mid caps, around 25% for the small caps, which has caused a lot of damage to portfolios as well. And these are the indices. Stock level declines could be more severe than what the indices are overall showing. Now let's look at how bad has been the fall. So what we've done in this slide is we've taken the top 500 stocks, and we've looked at how many of them have had a more than 30% fall from their 52-week highs. So if we look at mid caps and small caps, around 2/3 of the mid caps and small caps have actually fallen by more than 30% from their 52-week highs. The number is more like 50% for large caps, around 60% plus for mid caps, and around 75% plus for small caps. Similarly, if we look at the data for this calendar year only, this was from 52-week highs. But if we look at in this calendar year so far, out of these same 500 stocks, a more than 20% fall has happened in around 1/3 of the mid cap stocks and more than half of the small cap stocks. So while the market overall has faced a lot of damage, this segment of the market has borne the brunt of the fall. Now let's look at what have been the key reasons for this fall, and then obviously we will look at what is the outlook on each of these aspects going forward. The primary reason in our view for the fall is the uncertainty that has been surrounding markets uh, or from a global trade perspective. With the new regime in the US, the expectation is that emerging markets will get impacted the most, because emerging markets are the ones that produce and supply the goods that are sold into the largest consuming market of the world, which is the US. There have been multiple announcements around the tariffs. There were tariffs imposed on Canada and Mexico. Then they were delayed by a month. Then they were again reimposed, and perhaps on Mexico they could again be delayed by a month or so. Then there have been talks on additional tariffs on China by around 10%. Then there are talks about reciprocal tariffs, which essentially means that the US is going to charge the same tariffs on a particular segment of goods as to what the exporting country or what the importing country charges it. Now, there is a lot of uncertainty surrounding this. Do we know how the path is really going to pan out? The answer is no. But the key aspects through which we would like to analyze this situation is something which we will come to in the later part of our discussion. The only point to be highlighted over here for now is the fact that India is maybe the 10th largest exporter to the US. We are not amongst the top 3. We are not amongst the top 5. We are not amongst the top 7 exporters. Our trade deficit with the US is maybe 1/6 that of China. For us, US is important because about 17% of our exports go to the US. But from US's perspective, there are far more bigger and important trading partners for the US than India. Hence, the first level of tariffs that have been proposed are on Canada, Mexico, and China. Also, there are other aspects that the nation of US wants to tackle with its neighbors like Mexico and Canada. It could be due to border immigration related issues, border control related issues. It is also related to trafficking of drugs, etc. Hence, this could be used potentially, the tariff issue, as a negotiating tool with its neighbors and with some of its larger trading partners. As far as India is concerned, our Prime Minister has visited the US. Our Commerce Minister is currently in the US. There is a bilateral trade agreement that is in the works. There are a lot of exports that we do to the US, which are important to the US, like pharma, etc. And the exports that the US does to India is not that substantial. So let's say while we do levy some duties on pharma exports from the US does not levy any duty. So could we lower the duty in India without significantly impacting the domestic producers? The answer is yes. So our sense would be that India would be in a good position to negotiate, work out a good bilateral trade agreement with the US. Also, the US will not be able to manufacture all that it consumes. Hence, it will definitely be dependent on imports from other countries. And our sense would be that given that we are relatively lower in terms of the trading relationship with the US, we could actually be net beneficiaries. Hence, there could be higher tariffs on some of the larger trading partners of the US. And as US will still need to consume, actually some of the uh, manufacturing or some of the sourcing could shift from the larger trading partners to countries like India. The one other aspect is that the current regime is there for the next 4 years or so in the US, and any factory to start being set up in the US and then to come about in production will take about a couple of years at least, because the approval process in the US is also quite tedious. Uh, so they will approvals would be required. After the approvals, there would be construction of the factory, etc. that would be required. Then there would be a stabilization process, and then the output will start to flow in. So, by that time, a couple of years would already be over, and the US will obviously be continue to consume during this period of time. So, manufacturing, even in US, if it picks up, it is going to be a relatively long drawn process. Also, a lot of the cost aspects would need to be borne in mind, because labor costs in the US are quite high compared to obviously emerging countries like India. The other aspect is that unemployment rates in the US are not that high. So would they be able to have the adequate number of labor force to man the factories will also be a question. Also, the skill level requirement that is there for the different jobs, is the labor force there for that? That will also something that would need to be evaluated. So this could perhaps also be a negotiating tool for the US to bring people on the table, to bring countries on the table and negotiate agreements with them. And our sense is that India is relatively better placed, and India could actually be a net beneficiary out of this. The other aspect which has caused uh, the decline in the markets is the fact that even in this quarter, the earnings growth has been in about single digits. But that was actually in line with expectations. So while the first half of the current financial year, earnings were disappointing expectations, Q3 earnings have largely been in line with expectations. Yes, the earnings expectations themselves were muted. Yes, the earnings expectations were in single digits, uh, and they came also in line in single digits. But the point is that there was no major disappointment in earnings. Large cap earnings were largely in line. Mid cap earnings actually were ahead of expectations as a basket, while small cap earnings were below expectations, and that pocket of the market did disappoint. In Q4, and as earnings starts to pick up, and then in FY26, as growth starts to play out, our sense is that some of these earning related uh, concerns will start to fade away, as in FY26 we will in our view are likely to see double digit earnings growth. Then the other aspect has been the FII selling and the ferocity of the selling. uh, FIIs have sold a very large number in the last couple of months and also in the previous months before that, and we will go into the reasons of that. One of the key reasons actually has been the currency. If you look at it, the Indian currency has depreciated by around 5.5%. Out of that, around 3.5% has come in the last 3 months. The sudden depreciation of the currency actually creates jitters because it impacts the returns of FIIs, and also uh, when there is a sudden fall, people start to fear how low can it go. When it's a gradual fall, people adjust to that reality in a gradual manner, but when a fall happens in jerks, it creates a lot of fear and anxiety. Our sense is that as the concerns around tariff start to get addressed, as India negotiates a trade deal with the US, as crude oil prices are coming down, which is beneficial for India, so that will help inflation as well. As yields start to stabilize, we will see a stabilization in the currency, and that will also, stop the ferocity of the selling that we've seen in the FII basket. If we see the DXY has already corrected a tad bit from its highs that were seen in recent times. If we look at the extent of selling that has happened in the FII basket, so since October, or let's say broadly last 5.5, 6 months, FIIs have sold actually $25 billion in India. So since October, FIIs have actually been selling the entire EM basket. It is not that they have been selling only in India. Most EMs, if we look at it, there has been selling, and a lot of this has to do with the strength in the US dollar. US yields have been going up, US markets were going up, and there was fear, global uncertainty. During times of global uncertainty, the general flight is towards the US dollar, and that has what has played out. And investors have sold here. They've invested in the US, and also parts of investments have gone to China. And the reason for that has been that post DeepSeek, there has been greater belief or confidence that China is not behind the AI curve, and Chinese markets have been very, very attractive in terms of valuations. Also, there have been recent stimulus measures and pronouncements by the Chinese government, which are more pro-business in nature, and hence there has been a tactical kind of a bounce in the Chinese markets. If we look at on a yearly basis, already in this calendar year, FIIs have sold around close to $14 billion. And the impact of this selling has been the sharp correction in the markets that we've seen. So the question that gets asked to us often is, when are FIIs going to return? So our sense is that once the currency stabilizes, once the fear around tariffs, etc., get addressed, once the strength of the US dollar, as we've seen versus the DXY, in the DXY, sorry, that it started to already get reflected, things will start to improve. Ultimately, India does remain a solid long-term earnings growth story globally. And as this FII selling was also to do with the fact that there was a slowdown in earnings. And now let's look at the fact of what are the positives that the markets in the current sentiments are ignoring. So our view is that a lot of the pain that we've seen in the markets is due to bad sentiments and bad liquidity. Bad sentiments is due to tariffs, the impact on emerging markets, the currency, etc. And the bad liquidity is due to the FII selling. So firstly, on the geopolitical side, there is positive news. There is ceasefire in the Middle East. Perhaps there will be resolution of the Russia-Ukraine war as well. If that happens, that will help supply chain issues getting resolved. Freight costs are going to come down. Also, crude oil prices, we've already seen the benefit that crude oil prices have started to correct and actually have corrected quite a bit. So that is net beneficial for India because India imports 87% of its crude requirements. Part of the benefit of lower crude prices is being taken away by the weakness in the currency. But as the currency kind of finds its strength back, the true benefit of lower crude prices will also start to flow in. And the resolution of the global conflicts helps bring down uncertainty, and that is a positive which is currently getting ignored. The second aspect is that the budget was a pro-growth budget, and we'll come into the details a bit later. RBI has been easing liquidity. Systemic liquidity has been tight, continues to be in deficit, but RBI is taking various measures to ease that situation, which will start the rolling in the economy. Inflation is trending down, led by cooling of vegetable prices. This has enabled the RBI to cut rates. Yes, the rate cut cycle in India is unlikely to be a very deep or long one. It is likely to be a shallow rate cut cycle, but we started with 25 bips. The cooling of inflation and the cooling of uh, and the cut in rates does provide visibility for growth going forward. And obviously, rate cut is very good for the entire manufacturing infrastructure kind of a basket. Also, Q3 earnings, as we discussed, were largely in line with expectations after a muted H1 where we had seen disappointments. Going forward, we think that earnings will start to provide support. There have been positives in the economy in terms of, the agricultural crop is likely to be good. We've also seen a good marriage season. Also, the fact that government capex has started to pick up. So government's capex in the first half of the year was actually down. In November, government capex increased by around 94% YOY. That was to catch up on the slowdown in spending that was seen in the previous months. In the month of January, also it increased by around 50%. So YTD, that is still Jan, government capex is actually up by 5%. And hence the government is likely to meet its capex growth target of around 7% this year. So the pickup in government spending is also good for growth in the near term as well as going forward. So all of these positives currently the markets are ignoring. As far as the budget is concerned, three key points I would like to highlight on the budget. Uh, it continued on the path of fiscal consolidation, which is very good for the long-term structurals of the economy because it structurally keeps inflation in check. It restores investor confidence that Indian government is not going to be profligate and that we will spend within our means. Secondly, there was a good boost to consumption given the tax cuts. Thirdly, the capex focus of the government continued. While the headline capex number is growing by around 10% YOY versus the growth that is likely to be around 7% in FY25, if we make the required adjustments, then the capex growth numbers are more like around 17% YOY. This is because some of the capex expenditure numbers need to be properly reclassified. And if we look at it, then it is a good double-digit growth number. Also, in addition to that, the budget did highlight that PPP frameworks would be made to get the private sector to participate in infrastructure. Obviously, it will take another maybe a couple of quarters at least to get those frameworks in place. So maybe from the second half of the year, we could see PPP projects also getting finalized. Then private sector capex cycle is also likely to pick up with the pickup in demand, with rates being more supportive. So that is also going to aid the overall capital expenditure growth in the economy going forward. So this chart is on crude prices. Obviously, if you look at it on a YOY basis, we were about $85 or so last year, and we are more like $75, $70 or so now. So a good reduction in crude prices. Domestic liquidity continues to be supportive of markets so far. We have this data till the month of January. So till that time, SIPs on the mutual funds continued. What has happened in the markets is that the incremental buyer has become relatively more cautious. So while those who had to sell, so let's say FIIs, while they were selling, given that the selling has been continuous, the incremental buyer is now waiting, and he or she has become more cautious today before buying. So that has also resulted in the markets becoming a bit shallow and is also getting reflected in the pain in the markets. So once the confidence kind of returns, then we will see that the liquidity will also start to improve. And till the last data that is available, at least SIP flows are continuing, and the domestic investor is continuing to invest. If we look at valuations, which is the last piece on the market outlook before we move to our portfolios, given the correction in the markets, valuations now at around, let's say, 19 times 1 year forward are below the 10-year average of around 20 and a half. So if we look at 10-year average levels, we are about, one could say, 5% or so levels below that. Obviously, portfolios stocks in many pockets would be substantially lower than this because the index does manage to hide a lot of pain. But one could say that many pockets of the markets are today attractively valued given the long-term growth potential. Now coming to our portfolio specifically. So what is the breakup of our portfolio? So roughly around 37% of our portfolio is in large caps. One could say that about 60% plus of our portfolio is in mid caps and small caps. And hence, while the portfolio was doing fairly well till very well till December, in the last couple of months, we've seen pain in the portfolio because of the fall in these two portions of the market, wherein let's say 60% plus of our investments reside. How is our sectoral exposure? So, the themes that we are playing are largely manufacturing, infrastructure, defense, etc. Defense is around, let's say, 1/5 of the portfolio. Capital goods is around 15% of the portfolio. Defense is around 10% plus of the portfolio. Then there are other sectors which are supportive of all of this. So we have around 14% in input components. Input components are things like cables and wires, structural pipes, etc. Then we have cement, which is 5%. We have infrastructure, which is 10%. We discussed in infrastructure. We have ports, aviation. Then we have construction, which is 6%. In construction, we have players like L&T, etc. Then we have 6% in energy. Then we have 6% in power, where we have a power utility, we have a power financier in this. In railways, we have a 3% exposure where we have a wagons manufacturer. In capital goods basket, we have companies which are related to the power sector essentially. It could be power generation equipment manufacturers, it could be transformer manufacturers. And then we have an auto component manufacturer, which is also into manufacturing of rail wheel sets and also exporting from India. So largely all the investments predominantly are in the themes that we are invested in, well diversified across various subsectors and investing in leadership businesses where we believe that good growth is visible. How has been the growth of our portfolio companies in the quarter gone by? So versus the market or the Nifty, if we look at it, the growth has been about double that of the Nifty, but a more representative basket would be the Nifty 500. There also the growth of our portfolio companies has, let's say, been around 35% higher than this benchmark. If we look at the 9-month number, in 9 months, the portfolio companies have delivered a healthy operating profit growth of around 19%, which is about in line with the growth that they've delivered in Q3 as well. Similarly, if you look at the outlook for the full year, we are expecting a 20% kind of a growth from our portfolio companies at the operating level, which is about double the growth that is expected from the market. And for next year also, the growth that we are expecting is 20%, which is about 50% higher than that of the market. At the PAT level, the growth is much better. It is not that we are just forecasting good growth numbers going forward. If we look at the portfolio companies and the PAT that growth that these portfolio companies have delivered over the last 5 years, again, it has been a good 20% plus kind of a growth number with a good return on capital. So if we look at the key psychographics of the portfolio, excuse me, so the EPS growth or the PAT growth that we are expecting is in excess of 25% at the minimum. For next year, it's actually 30% plus. If we look at the return on equity that we are expecting from the portfolio, it is in excess of 23%. The leverage levels in the portfolio are extremely manageable with a debt to equity ratio of only 0.2x. So overall, the fundamentals of the portfolio are quite strong. While there has been an impact in recent last few months due to the selling in the mid caps and small caps, we believe that given the earnings delivery that has happened and will continue to happen going forward, the bump up in growth that is likely in FY26, pick up in government spending, increase in government ordering activities, which we've already seen in the power sector, in the defense sector, we are on a good sound footing going forward. In fact, in the last few days in the week of March, we've already seen starting to see recovery in the portfolio. So, Pratmesh, we are about halfway through, so I'll stop here and would like to address the queries that the participants would be having. Over to you.
Yeah, thank you, Sandeep. So actually, we have received quite a lot of questions. So I will
Sure.
put as many as possible to you. So one of the first questions that we have received is that markets have fallen sharply. So this has impacted people's portfolio as well as affected Lighthouse portfolio. So the first question is slightly subjective, but how do you deal with this psychologically? If people are asking, in the sense, how do you repose your faith in India's story in today's turmoil? I mean, how do you keep long-term perspective?
Sure. So, see, whenever there is a fall in the markets, portfolios experience damage, there is obviously a lot of pain that is experienced through the value chain by everyone. The way to think about it is that what impacts markets is sentiments, liquidity, fundamentals, valuations, and the interplay of all of this, and some other factors as well. But let's focus on these key factors. Let's say we are sitting in March today versus even a few months ago, let's say in the calendar year 24. What has changed largely is the sentiment today is negative versus what was the case in the calendar year 24. What has changed is the liquidity because the ferocity of selling by FIIs has been quite high in the last few months. Fundamentals of the economy actually remain intact. Is there uncertainty globally due to the tariff in wars? The answer is yes, there is. Do we exactly know which path it is going to follow? The answer is no. But at the end of the day, all the players involved would like to have a win-win situation. Could there be some give and take? The answer is yes. Given costs, given labor issues, given the timelines required, it will just not be possible for the US to manufacture everything. And given that we are not the largest, amongst the largest, we are the 10th largest trading partner, not the top five or so, I think we could actually end up being net beneficiaries. From a geopolitical context, also, it is important for the US to partner with us in our view. So I think that this negative sentiment will get addressed by the strong fundamentals. So, how do we keep our psychological sanity or our belief system? Is to continue to focus on the long term fundamentals of the economy and the fact that the fundamentals have not changed versus what they were last year. Yes, is there a slowdown in growth because of muted government spending and ordering? The answer is yes. But we are already seeing a change in that with the pickup in spending, and ordering in a few sectors have started, and we believe that that is going to actually gain momentum going forward.
So that exactly makes sense to a second question. One of the participants is asking about exports. So will trade wars actually put a dampener on things? Because one of the key areas of Make in India initiative was encouraging exports. So will this trade wars put a dampener on things, or is there actually a silver lining wherein some of the Indian manufacturers or some of the portfolio companies from our portfolio will they benefit from these trade wars?
So that's a very fair question to ask. See, if we look at it, there are two or three aspects of the manufacturing context in India. First is the fact that we are doing import substitution or Atmanirbharta. That portion actually remains unaffected by these trade wars. We want to substitute a lot of what we are importing. That opportunity itself is very, very large. So, that leg is going to continue. Secondly, there are trading partners other than the US also who with whom we are actually moving forward on trade. UK is one example, the European Union is the other example. So that is the second piece that one needs to keep in mind. The third piece is the alacrity with which India has moved ahead, even with respect to the US, on negotiating a trade deal. So our sense is that we will see a good bilateral trade agreement with the US. So that is the third piece. The fourth aspect is that whatever the US consumes, it just cannot manufacture on its own. So it will continue to import, and you know a larger amount will continue to be imported for a length of time, for a long period of time. Also, within that, what it could do is wherever it believes that the trading partners or its importing nations are more friendly or with whom they have better relations with, they are likely to realign their supply chain towards those nations, right? And hence, India could actually turn out to be a net beneficiary of these realignments. We've already seen some news reports of some MNCs talking about, sourcing some of their production from India and realigning their global supply chains. So our sense is that yes, there could potentially be a silver lining out of this, in which India actually turns out to be a net beneficiary. Are Will this have no negative impact? No. Trade wars will have some negative impact in the sense that they will bring down global growth per se. The entire globe was functioning as, let's say, a relatively efficient unit so far. With trade barriers in multiple places, could that impact global growth? The answer is yes. But given the small size of our manufacturing base, given our geopolitical importance, given that we are not a very large trading partner to the US currently, and given that they have greater and larger issues with their bigger trading partners, hence we could still be net beneficiaries even in a situation where trade wars are going on.
Taking advantage of the recent correction, one of the participants is asking what kind of changes have we made to our portfolio? In the sense, have we added to certain stocks? Have we introduced any certain stocks? You can shed some light on that.
Sure. So, see, there have been a lot of violence in the markets in recent times. And the way we think about it is that we would not want to necessarily make changes, A, at the time of when there is such violence going on. Secondly, we are focused on fundamentals. As we said, what has changed is sentiments, what has changed is liquidity. Fundamentals have not necessarily changed. As we are picking stocks on a bottom-up basis and the fundamental long-term story of those stocks are intact, the portfolio remains largely the same. Having said that, if something, because we remain invested about largely at all points of time, to invest somewhere else, we need to liquidate some other position. So, because let's say if stock A has relatively held out well during this period, and in fact, some of the stocks have given good returns as well, uh, and outperformed, then we might want to book profits there just to invest somewhere else in pockets where there has been a lot of damage due to the current environment while the fundamentals remain intact. So those tweaks, realignments, we'll continue to do and we have been doing. But net, is there any major fundamental shift to the thinking, to the portfolio construction? The answer is no. See, anyways, in terms of the quality of the businesses that we are owning, we are anyways, in our view, owning businesses which have good quality of managements, good balance sheets, good returns on capital, good cash flows, and the growth outlook anyways in our view is good. So, there are no major changes which are required in the portfolio.
So this brings us to the next question, which is regarding FIIs. So you have already spoken about FII selling which has taken place. So one of the participants wants to know what would be the conducive conditions for FIIs to return to Indian equities, to return back to Indian shores.
Sure. See, I think currency is one important aspect for FIIs because ultimately they are earning dollar returns. As we saw, the currency in the last 3 months the rupee has depreciated by around 3.5%. Generally, a 3.5% kind of a depreciation we've seen in the past in the rupee in a year or so on an average level. But when these large fall in the currencies happen in a relatively short period of time, it creates a lot of fear, anxiety, and investors would like to preserve whatever returns they have and they would like to, move away. And, some of the hedge fund participants, especially, they trade on such thin margins that this kind of a movement in the currency kind of really impacts them. So I think a stabilization of the currency is one aspect. Secondly, the fear today which everyone has is around the tariffs. And there is going to be some working that would be required for the tariff environment to settle down. If we speak in terms of timelines, what we understand from news reports currently is that 2nd April is the time when reciprocal tariffs come into play. Whether they will come into play for India or not, we really don't know because India is currently negotiating a bilateral trade agreement. And, initially, at least news reports suggested that the first phase of the bilateral trade agreement could be finalized by November. So, that is a long time. So we really don't know whether the reciprocal tariffs would be applicable to India from 2nd April on. Also, in the budget, the government had actually preemptively already reduced tariffs on a few items. Now, from today till 2nd April, could the government reduce tariffs on more items? The answer is yes. And could this happen progressively over the next few months? The answer to that is also yes, till the time a bilateral trade agreement is fully negotiated. So I think that will also help bring down concern levels on the tariffs. Then, at some point in time, valuations will also start to matter. As earnings growth start to play out in our view, and from a valuation perspective, there are pockets of the market which will start to look attractive. In a global context, India still, very well remains a solid long-term growth story, and hence the FII interest in India is likely to return back, once all of these issues are kind of resorted out, and once growth starts to come back, sentiments, liquidity, and all of that can change.
So speaking about valuations, so manufacturing infrastructure stocks, some of the stocks have had run up quite a lot in last 1 year. So has the recent correction made any pockets in this particular sector, any quality names attractive?
So the answer to that is yes. See, if we look at the fall in the mid and small cap basket, as we saw the data from 52-week highs, around 2/3 of the mid and small cap basket have fallen by 30% or more. So irrespective of the sector, and irrespective of whether it is good, whether the quality is high or not, whether it is consumption or maybe infrastructure or IT, or across sectors, we have seen uh, a very good fall in stock prices. Uh, so hence, yes, the answer is yes, that it does make many of these pockets quite interesting in terms of valuations given the growth outlook. But the point, Prathamesh, here is that what we already have is also fallen. To buy something, we need to sell something in our portfolio, and what we have is already also corrected. So then, could we do realignments in the portfolio to sell some pockets which have not fallen as much or actually have outperformed in this environment to invest where the fall has been greater? The answer is yes. But would that be the case for a large proportion of our portfolio? The answer is no. So yes, some tweaks, some changes here and there will continue. But yes, have pockets of the market become attractive because of the fall in the prices? Yes, the answer that has indeed happened because the fall has been across.
So one of the participants is asking question about our top holding. Can you list out the rationale behind why Interglobe Aviation is our top holding currently?
Sure. So, Indigo Airlines is the largest airline in the country. In fact, by number of passengers handled, I think it's the seventh largest airline globally. Indigo handles around 10 crore passengers annually. The Indian market is around 15 crore. Indigo has around 62% market share, so it is a leader. As we said that we generally invest across leaders in our portfolio. It is a very good play on travel infrastructure. There is a lot of government focus on improving connectivity. We've seen a lot of airports coming up. We've seen regional connectivity programs. And Indigo has the lowest cost provider of this commoditized service, if I may use that word, and it has a good cost advantage over its nearest competitor. We expect good double-digit volume growth or ASK growth, which is available seat kilometer growth in Indigo. Indigo has one of the largest order books or largest planes on order globally. And aircraft supply chain is actually under a lot of pressure. So having such a large order book holds it in good stead because it ensures it a very good visibility of aircraft supply over many years going forward, in an environment where aircraft supply is constrained. And it has been able to get this because it cut the deal early. And what it also got is a very good price. In this business, which is, a very, in some sense, a capital intensive business, capital costs are very important. And if you are able to buy in bulk, which Indigo was able to, it helps bring down the cost of purchase significantly, and hence Indigo would have got a very good discount on the aircrafts that it would have purchased, and hence that gives it a very solid cost advantage. Also, its aircrafts are very fuel efficient. It will also be a beneficiary of fuel prices that have been going down. Lastly, while it is a large domestic airline, India still does not have a very large international or a global airline. If we look at all large economies, all of them have, at least one large global airline as well. While that is not the case with India, Indigo is obviously increasing its international presence. It has wide-bodied aircraft on order. And so that is the next leg of growth, which will get supported in its journey through international operations.
So coming back to the part about manufacturing, one of the participants is asking is pharmaceuticals are a part of the overall manufacturing sector. So any reason why we don't have any exposure to pharmaceuticals, especially in today's time when pharma is seen as a defensive bet in volatile times?
So, yes, pharma is in some sense a part of manufacturing. See, manufacturing per se is a very, very broad term. So, while the bulk of the manufacturing exposure that we would be having currently is more in the electronic manufacturing space, manufacturing could include auto, manufacturing could include pharma, manufacturing could include textiles, anything and everything that is produced in factories in some sense manufacturing. We do own pharma in our other funds, but in Lighthouse, we do not own pharma because while yes, in the broad brush, manufacturing, would pharma fall? The answer is yes, as we said that, anything which is produced in a factory is manufacturing. But, if we really want to make a pharma a key holding or pharma stocks a key holding in our funds, we would actually, define healthcare as one of the themes in the portfolio to have a major, representation of pharma in the funds. But have we done it as of now? The answer is no. But yes, we do have it in our other funds.
Oh, okay. So one more question related to the manufacturing place, infra and engineering space is related to Ultratech. So Ultratech has forayed into cable and wire space. So which has sparked concerns of intense competition and price war. So what could be the impact of this on the cable and wire stocks which are in our portfolio?
Sure. So in terms of price impact, honestly speaking, we've already seen the impact on the cables and wire stock in our portfolio because of it. But if we look at the fundamentals, see the industry per se is growing at a high single digit rate. So broadly speaking, it is an 80,000 crore industry, which is growing at 8 to 9% per annum. The larger organized players are growing in double digits, in about teens. So this industry, let's say could potentially double over a period of time. Ultratech's plants is going to come in a couple of years from now. After that, it is going to take a couple of years to fully ramp up, right? So there is good 3-4 years for the companies in our portfolio to continue to grow. So that is point number one. Secondly, the market today is large enough to accommodate a new player. Thirdly, the major focus of Ultratech is likely to be on wires, at least in the beginning, because cables is a business wherein a lot of approvals are required. Cables is largely a B2B business wherein approvals are required from each customer, and those approvals itself is a tedious process which is going to take a few years after those 3-4 years that we've talked about, right? So that is the third bit. Fourthly, for our companies, wires is about 1/3 of the business, around 30%. So it is not that the entire business is getting impacted. Fifthly, the channel for selling cement is different from the channel in which electrical products are sold. So it is not to say that, let's say Ultratech or some other competitor in future will not be able to become successful. Yes, they might be able to become successful if they execute well, but it is going to take time, because this is a business in which there is a pan-India distribution which is required and which is different from cement. Also, the market is large enough, so it is not that the business of the incumbents is getting disrupted. And there is enough and more growth opportunity available for everyone to participate in. And we believe that yes, I mean, has it impacted sentiments, concerns, or fears are there? The answer is yes. But as we said, that as the fundamentals start to play out, as the earnings growth numbers of of the incumbents continue to be delivered, it will be realized that these are also solid businesses which are continuing to deliver, and then in our view confidence will return.
Okay, so this brings us to the question about the market turnaround. One of the participants is asking, how long will it take for the market to turn around? As have we reached the bottom, or do you feel that over another few months we'll continue to see volatility?
See, honestly speaking, it will be very difficult for us to say whether the market has bottomed per se or not, because uh, you know it is a very unpredictable thing, and it is at least beyond our capabilities to exactly answer whether the markets have bottomed or not. But let's look at a framework or the way to think about it. The way we would think about it is that today's sentiments around globally around emerging markets is weak. Today's sentiments around the currency is weak, etc. Now, once the sentiments get addressed either through stabilization of the currency, we've already seen DXY kind of topping out or starting to correct. As crude prices are coming down, which benefits India quite a lot because of our 87% plus imports of oil, etc. And as the news flow around the tariff reduction in India for US imports start to flow through, because I believe that India will negotiate a good trade deal with the US, that also starts to happen. Those concerns and sentiments will start to get addressed. As far as liquidity is concerned, as the currency stabilizes, as the fundamental numbers start to flow through, given the attractive valuations in many pockets, I think the pain that we've seen on the liquidity side will start to ebb. Lastly, as the fundamentals and as the growth numbers start to play out, as we've seen on the government side, we talked about the capital expenditure growth that we've seen in December, then in January. We've seen the news flow around systemic liquidity getting eased by the RBI, the rate cut. And then as some of the ordering activity picks up, the benefits of the tax cuts, etc., start to flow through. We saw a very bad Q2 GDP growth number. Then Q3 was better. The government, as per government estimates, Q4 is likely to be better. So, as these numbers start to play out, I think confidence will start to return. As to the timeline, yes, all of us want this to happen as soon as fast as possible. But honestly speaking, to comment on the exact timelines would be difficult. But yes, one would like to believe that a large part of the pain is, largely the pain is behind us. Yes, but we keep our fingers crossed.
So that brings us to our last question. A lot of people are asking in the chat box whether how do they deal with the markets currently? Should they adopt a staggered approach to investing currently, or is this the right time to go all in? You can share your thoughts on that, and apart from that, if you have any closing thoughts, you can share those two.
Sure. So, honestly speaking, Pratmesh, it's always a good thing in volatile markets to stagger one's investments. The reason is that emotionally it helps a person to deal with the situation in a better manner, because honestly speaking, we also don't know what is going to happen in the markets tomorrow. Suppose there is some tweet from the US tomorrow, right? There is some news flow around tariff that comes out. That can have a sudden dampening effect on markets. Will it change fundamentals drastically? The answer is no. But can it change sentiments and liquidity for a short period of while? The answer is yes. Hence, it could be, it might be more sensible to stagger one's investments. Having said that, because we have already seen a lot of pain in the markets, it might be a good idea to stagger the investments over a relatively shorter period of time than a longer period of time. Because a lot of the pain has already come in the last couple of months. Yeah, so that is the way to invest in the current volatile times, in my view. And thank you so much, everyone, for your patient hearing, and have a very good weekend.
Thank you, Sandip sir. That was extremely insightful webinar. Thank you all the participants for joining us today. So you can subscribe and follow our YouTube channels for many such market insights and updates. Yeah. Thank you very much.
Thanks a lot.